Good afternoon, everybody. Welcome to the TreasuryONE webinar, where we're going to discuss what's happening in the markets currently. Obviously, the theme of it's going to be discussion about what's happening in the US markets at the moment, but relevant that's happening outside in South Africa in the streets, especially in Durban and Gauteng, is the current looting of state resources and local resources and retailers and malls. We are going to focus a little bit on what's going to happen with the fiscus and the impact of it. Joining us today is George Glynos from ET Analytics to unpack it a little bit, and afterwards myself, Andre Cilliers, and George will take questions and discuss what's happening. Over to you, George.
Thank you, Wichard. Afternoon, everybody. If you just give me a sec to share my screen, and Wichard, if you can just confirm that you see it, should come up any second now.
Yes, thanks. I can see it, George.
Okay, great. Then let me press ahead with just see if I can. There we go. So the title of this presentation, unfortunately, was titled "From the Amazing US Recovery from the Sublime to the Ridiculous," which is what's going on in South Africa at the moment. I thought, let me just try and get the South African stuff out of the way first, because it's essential to understand context about what's going on at the moment. And honestly, I don't know that talking about the US without having discussed some of what's going on at the moment is prudent. So let's just cover some basics to give you some perspective as to what we think is going on right now. Initially, this whole unrest was classified or characterized as a big support for Jacob Zuma. I think there was definitely some support for Jacob Zuma, but we're talking about a real minority. We don't believe that it was widespread support for Jacob Zuma. What ultimately happened is that you had a small cabal of people that were initially felt very frustrated at the way that Jacob Zuma had been treated, and responded with a lot of violence and threats and intimidation, and we saw that just ahead of Jacob Zuma getting arrested or handing himself over. That is what ultimately spilled over. We think that was more tantamount to a spark that lit a tinderbox than it was the real reason that we're in this mess that we're seeing at the moment. We think that the real mess that we're in is a function of something far, far deeper than just what you see at face value. What you see at face value is real. I'm not trying to downplay it in any way, but what I think we miss when we just have a look at the superficial here and now is the context which led up to all of this. So I've got a few slides here just to paint that picture, and then we can open up with that context. We can have a debate about what that ultimately means and whether or not this is something SA can recover from quickly, whether it requires a long-term sort of approach, what that is. So the very first chart is one of what they call the Gini coefficient. This one's produced by Credit Suisse. It's not the World Bank version, primarily because it's more up-to-date than the World Bank version. So I thought I'd bring it up for you because not only has it been generally rising, which is not what you want to see, the higher the number, the wider the disparity between rich and poor. That is what a Gini coefficient effectively measures, the gap between rich and poor. South Africa has got the very poor status of being the world leader. In other words, number one in the world for the highest Gini coefficient. That's out of 150 something countries. South Africa has, in other words, the highest income disparity in the world. And it's quite staggering when you think about that, because we've had almost a quarter of a century of ANC rule. And ANC came in on a ticket of redistribution. They were talking about redistributing assets from the previously advantaged to previously disadvantaged. And this was supposed to move in exactly the opposite direction. But such have been their economic policies that they've done South Africa no favors. Their service delivery has been so poor, and I'm not just referring to service delivery of rural areas. I'm talking about service delivery on things like education. I'm talking about service delivery on things like infrastructure, on state and enterprises and the like. It's a catch-all phrase for general government performance across the board, and that's been poor. And the net result of that is that they haven't been able to achieve what they wanted to achieve, primarily because not only have South African assets been utilized very inefficiently, but they've generally gone into the wrong direction. So Gini coefficient, the highest in the world. South Africa's unemployment rate is also a disturbing statistic. From there, where we were hovering around 20% unemployment in '94, we are now sitting at an unemployment rate of around 32, just over 32%. If you look at the broad measure of unemployment, where they don't exclude people that they classify as having given up hope of finding a job, the number rises substantially further. I think the real number probably sits somewhere in between these two, but you'd still be talking about an unemployment rate approaching 40-odd%, which is staggering for a reasonably developed country. Even worse is what happens when you look at youth unemployment. So youth unemployment is sitting at a staggering 62, 63%, which is, I mean, effectively it tells you a huge story there. If you adjust that for along racial lines, you'll find that the vast majority of youth unemployed tend to be from black previously disadvantaged, the black previously disadvantaged cohort of youngsters aged between 15 and 24, which makes matters that much worse, because you're talking about people that are struggling to find jobs in an underperforming economy. They are poorly educated. There's not enough capital to start enough businesses to be able to absorb this level of unemployment. And then on top of it, you've got lack of service delivery, where even if you do go into the rural areas, and here I am talking about more of a municipal lack of service delivery, you find electricity setups are poor, water reticulation is even worse, roads are falling apart. So all in all, this is the cohort that probably feels the most disenfranchised and the one most frustrated that after years and years and years of ANC rule, that they land up in a position worse off than they were 10 to 20 years ago. One of the biggest problems South Africa has faced has been the quality of education. So again, going back to the theme of service delivery, and you begin to realize just how poorly South Africa has performed. South Africa, and it's difficult to see on this chart, but on the bottom right of this chart, you'll see a little red block. That's just to indicate which line is South Africa's. We are at the bottom. We did have the likes of Tanzania below us, but even they've pipped us now. So out of all of these African countries, the quality of education index as calculated by the Ibrahim index of African governance is right down the bottom. The same methodology gets utilized across all these countries, so they are comparable. And it gives you a sense of just what I'm referring to. If you cannot educate your youngsters, and you cannot produce a cohort of school leavers that have got an education strong enough to be able to take them into tertiary qualifications or into some form of technical education, you will find that you have a cohort of those 15 to 24-year-olds that I was talking about being largely irrelevant in a modern day economy. And that status of irrelevance is something that is quite profound and fairly shocking. You can imagine the hopelessness that comes along with people that just cannot find themselves being relevant in an economy in which they live. To add insult to injury, we've had a little bit of our own Arab Spring, and it's not just about the background, deep-rooted assessment that I've given you so far. It also happened as a result of COVID. So COVID's come along and dealt this economy an almighty smack. Now, already what we had was an environment where gross earnings, the blue line, was effectively steadily trending lower. Came the beginning of 2020, COVID hit, and those gross earnings suddenly fell off a cliff. Whereas gross earnings were there or thereabouts with inflation just before the crisis, well, we're well below inflation now. So it's not just a case of people becoming unemployed, it's also a case of businesses, in order to stay afloat, have had to cut costs, have had to put wage freezes in place, etc. It's made household finances that much more difficult. If you are fortunate enough to even keep your job, you still find yourself going backwards relative to inflation, because generally speaking, that's what happened to gross earnings. Earnings were under pressure and came under colossal pressure during the pandemic. So it shouldn't surprise you that the governance indicators that are picked up from the World Bank have been steadily showing that South Africa's resilience to political instability. In other words, so what you want in this indicator is that blue line to go up. The higher the blue line goes up, the more it means that South Africa is in a politically stable environment. The more that erodes back down, you find yourself in a politically unstable environment. Of course, I've marked in those two vertical lines the recession years. So 2009 was the first recession year. That we can't blame on Jacob Zuma. What happened post that, we can blame on Jacob Zuma. Of course, now we're sitting in 2020 where the next recession hit, and you can imagine what's happened in 2021. We believe that it's done something along the lines of that red arrow. And so, again, political instability on the rise in South Africa, and the absence of violence, unfortunately, is wilting away. So that, I think, brings me just to the end of the little essay portion that I stuck into this presentation, because I thought it was important for us just to keep that context in mind. I'm now going to switch across to America, because that was, in fact, the purpose of this presentation in the first place, was to talk about the US cycle and what's unfolding in America. Because, you know, when we think about the dollar rand, it's not just about what's going on in South Africa, it's also about what's going on in America. And what's going on in America can sometimes be even more definitive and in terms of driving direction in the dollar rand than local developments. So I guess the first point of call is just to put us in the right perspective. So what I've got here is the US leading indicator, which is the blue line, effectively leads US GDP, which is the red. What we can see very clearly from here is that the red line's still got to catch up to what the blue line's done. These two lines correlate pretty well, so I am expecting the second half of 2021 to be quite a strong one for the US. And in fact, we think that will spill over well into 2022. So the business cycle in America is very much on the rebound and is expected to rebound very, very strongly through the course of the next 12 months. So that's the broad-based business cycle. Much of that has been generated by a Fed that has continued to conduct quantitative easing flat out. It has built very, very aggressively its balance sheet, as reflected in this particular chart. What took them 10 years to do previously, they've effectively done in a little over 15 months. It has been a staggering amount of quantitative easing that's been applied. And as they've done so, they fueled an economic rebound. Now, most recently, they've had an economic upswing that has started to take hold. Optimism is starting to grow, and it's not just within the private sector that it's growing, but within the Federal Open Market Committee, which is the Fed's decision-making committee, has also taken place. And so we looked with interest at what every time they meet, they produce these dot plots, which give us a sense of how all the different members in the FOMC are thinking about monetary policy in the US and where they believe interest rates might be. The green line and the gray line effectively give you the median of where those dots are. You can the big take home from this is that there was an upward revision to many of these dots through the course of the past meeting. And so immediately people started to question whether or not the Fed would indeed bring forward the timing of their rate hikes, whether the economy warranted the bringing forward of those rate hikes. It wasn't just about the business cycle. Although the business cycle was indeed turning higher, it was also a function of inflation, which I'm going to get to in a second. But just to reiterate the point that the kind of quantitative easing and monetary stimulus that was applied to the US economy was colossal. It was colossal to the extent that we've had the sharpest rebound in dollar liquidity that we've seen in over 60 years. So it is a significant move. The move up on this particular chart has been very powerful. It suggests that for a couple of years at least, we are going to have a fairly strong business cycle that will translate into global levels of demand being higher than what we've experienced more recently. And as a result of that, of course, the consequences, and we'll go into that in a second. One of the other consequences has also been to raise the growth in US money supply. Now, it rose extremely sharply in a way that I haven't seen in many, many decades. I haven't seen US money supply rise to this extent. Now, the relevance of money supply when we're talking about the US business cycle and inflation is that, well, there's a rule of thumb that we live by, and the rule of thumb is inflation can only take hold to the extent that money supply allows it to. So in other words, if you don't have a lot more money chasing goods, the opportunity for inflation to take hold significantly is far, far less. Now, what's quite interesting about this chart is that you can see that there's a very strong ramp up in money supply. So the money supply growth in year-on-year terms ramped up very, very sharply. But equally, it's now starting to come back down just as sharply. So the message to take out of this, and I think this is possibly the reason why the Fed believes that inflation is going to be, the inflation spike that we're seeing at the moment is going to be transitory and will not be sustained over the longer term, is precisely because the growth in money supply has not been sustained. It did initially spike on the Fed's actions up front, but equally it's starting to retreat now quite sharply, and the result of that is probably going to be to constrain the amount of space that's available for inflation to take hold. If I have a look at the leading indicator of inflation that we've created, which is the red line, you can see very clearly that that has spiked sharply higher. When you correlate that with US Treasury yields, you'll see that US Treasury yields are therefore also expected to go higher. There's no real surprise in that. This particular chart, just for the record, is a normalized chart, so you shouldn't be looking at the X and Y axis to give you any specific indication on what particular level we'll rise to. These are more like, if you like, growth rates of Treasury yields versus the leading index of inflation, which is again the red line. The point to make, of course, is that inflation is set to spike. We know that very clearly. It's also borne out quite neatly in the inflation expectation surveys, of which there are many. And it doesn't matter which one you look at, all of them are telling us that in the US, inflation expectations have risen, are still rising. There's no clear-cut timeline on when those are going to reverse. So the Fed is going to be looking at this very, very carefully. They don't want these inflation expectations to get too far out of hand, but they do still believe that the spike in inflation is going to be temporary. I guess the one worrying bit, and it's something that we've looked at, over many decades as well, has been the relationship between spikes in inflation that we've seen historically and what's happened to the economy shortly after. What we have found is that typically spikes in inflation have tended to be recessionary. Not only do they eat into the disposable income of households, and start to raise the input costs of production such that and you can't always pass those on wholesale onto the consumer, so that they constrain things like margin. You get margin compression through these phases, but it's also a time when the Fed has traditionally responded. There's a difference this time. The difference this time is that the Fed has increased the flexibility of its mandate. So now it's prepared to run inflation a little bit higher than normal, in the sense that if it does jump a little bit above the 2% mark, they're not going to respond as mechanically as they have done in the past. If they have good reason to believe that it's going to be temporary, they might just choose to ride it out for the most part and limit their rate hikes. So this time around, it's not absolutely guaranteed that just because we've spiked in the way that we spiked, that there is going to be a US recession. But it is important to note that once inflation does spike like this, history tells us that it doesn't remain very high for very long and can come back in the opposite direction. So we've got to be careful in how we interpret this when it comes to these developments overseas, and how we bring that back to being relevant for our views on dollar rand. If I plot the US 10-year, which you've seen in the previous couple of charts, and I plot that against the dollar rand, again, what I've done here is I've normalized these, so I've detrended them. What that effectively means is that I can compare, I can compare the one with the other to see what the relationship typically is, not to give us absolute levels. But what I found when I did this study was that typically you find that the rand blows weaker. In other words, these big red spikes, these big spikes up in the red line, the rand tends to blow weaker, interestingly, when US interest rates go lower. And I guess that stands to reason, because typically what happens is that when you enter a crisis, there's a rotation to safety. That rotation to safety is typally a US 10-year. As they rotate into US 10 years and will accept pathetically low yields just for the sake of keeping their money safe, so there's an exit out of emerging markets, and rand being principal of those. So you'll find that what happens to inflation and US rates does matter a great deal to what's happening to rand. And every time we've seen that blue line migrating sharply lower, it has coincided historically in those three blocks with a big spike in rand. This time around, we've already had that migration lower in those US bond yields. We've had the big spike up in rand that happened in April of last year when we went to 19 bucks to the dollar. Since then, US yields migrated back up again, and the rand strengthened all the way back down. What do you take out of that? Well, the big risk for the rand going forward is that inflation in the US remains elevated for longer than expected, and the Fed is inclined to step in and put the brakes on the US economy. The minute they do that, bearing in mind that a lot of these markets are very forward-looking in the way that they price things in. So that spike in interest rates, to some extent, has already happened. Yes, it could go a little bit further. I would agree with that, but But that in itself is going to come to an end and is also cyclical. So it matters a great deal how the US Fed responds to the spike in inflation, whether that spike in inflation is indeed temporary. If it is temporary, then the propensity for the rand to blow out significantly weaker isn't there. If it becomes a little more sticky and inflation doesn't come back in the way that the Fed expects, and the Fed is forced to jack up interest rates at the short end, it's likely to start pushing this blue line back down, and rand becomes a lot more vulnerable, because you'd be talking about an environment where the Fed would be actively looking at removing stimulus out of an economy. Your stock markets would probably take a bit of a tumble. Your rotation to safety would spike, and your rotation away from emerging markets such as rand would increase significantly. Right, so rolling all of that up into where the dollar is at the moment. Well, the dollar's come off quite a long way from its peak. It used to be somewhere in the region of about 25% overvalued. It's now overvalued by only about 3 or 4%. So the dollar's performance hasn't been great over the past year or so. Very much a function of what the Fed's been doing. It has been ultra loose. It hasn't looked at tightening. It has debased the dollar. It has allowed the rand to recover. It has protected risk appetite. All of those good things that have helped the rand remain strong and appreciate. Now again, we've got to relate it back to what the Fed's going to do, and whether or not they're going to respond with force to this potentially temporary inflation spike or not. If they respond, dollar will probably go stronger from these sorts of levels. If they're very cautious in the way that they respond to inflation and allow it to move above their target because they believe it's temporary and will come back, then dollar doesn't need to strengthen a whole lot, and rand can remain a lot more resilient than people anticipate for a while longer. For the time being, speculators remain dollar bearish. That's the blue lines below the zero. They're more keen to sell dollars than they are to buy dollars. That has placed a drag on the dollar, but the extent to which they've been prepared to sell has moderated a little bit. It's the reason why the dollar hasn't lost substantial more ground right now, and of course, when you turn the focus onto what's going on with US inflation, it makes it that much more difficult to try and gauge how these guys are going to respond. But ultimately, the dollar and the speculators appear to be more in a holding pattern right now than we have seen previously, where they were quite convinced that the dollar needed to lose ground. It's not the case anywhere near to the same extent as it was before. Capital flows into emerging markets have been strong, although we haven't really seen that in rand, I must be honest. Into emerging markets, we have seen some, but interestingly, that number has turned around. That red line is now starting to move back in the opposite direction. Again, that coincides with that holding pattern that I spoke about in the previous chart, where investors are looking at what's going on with the US Fed, US inflation, how the Fed might respond, whether they jack up interest rates, what that's going to do to the business cycle. And they're less convinced that it's obvious to just go into emerging markets right now. They're a little bit concerned that if the Fed does withdraw stimulus, that there is going to be a withdrawal, a sucking sound out of emerging markets. And of course, that red line then comes all the way back down. And countries that are more vulnerable, such as South Africa, take a bit of a hit. But in terms of South Africa and its economy, well, I mean, we were normalizing up until these riots hit. These riots are going to take quite a lot off in terms of South African growth. Not only have they destructed a whole bunch of property and stolen, they have removed what would have been value add into the economy, and they've sucked it straight out and replaced it with nothing. So it's not like we got any productivity out of this. There will be a rebuilding process that takes place afterwards, but that's going to be on borrowed money. It's not going to be out of savings, I can assure you of that. So there's been some distraction, and what that will ultimately do is make it more difficult for that blue line to get into the easier or expanding territory. That's kind of par for the course. We've been sub-zero for the better part of 6-7 years now, and these riots are not going to be helping. I guess the point to make out of that is that inflation, therefore, in a subdued growth environment, is likely to be well contained in South Africa. Our inflation risk index, which is the blue line, is not telling us that the red line, which is effectively the 18-month on 18-month growth in inflation, is likely to jump anytime soon. In fact, we think that it's going to remain pretty well contained, and if there's a risk, it's actually that inflation could surprise to the downside through the latter months of this year, going into 2022. So, with regards to the domestic interest rate outlook, that's what the Reserve Bank would like us to believe. Their quarterly projection model says that we should gradually find interest rates rising through the course of the next couple of years. I'm less convinced about this chart. Their quarterly projection model hasn't been great at predicting interest rates historically, and so I'm not placing that much emphasis on this. That's what the Reserve Bank has, and that's their forward guidance, all in a matter of effort to try and keep inflation expectations under control. But I think that black dotted line gets pushed further out to the right. I don't think we normalize as easily as what they've got there. And part of the reason also is because of the weak credit cycle. I think focus predominantly on the bottom chart here. Private sector credit extension is the blue line. It correlates to the left-hand axis, the left-hand y-axis. So you can see that blue line is dipped below zero. In other words, credit extension to the private sector is in fact contracting. And that was before these violent protests. So if you thought people were being cautious in borrowing and extending themselves before, well, you can imagine what's going to happen to this number after. So all in all, it's a very tight credit environment. And as I said before, inflation is unlikely to take hold in an environment where the credit cycle is as weak as it is right now. So the red line is, of course, the inflation, year-on-year inflation, lagged 12 months. So it tells us that over the next 12 months, we don't think that inflation is going to play a significant role. The relevance to Rand here, and like I often say, it's important for anyone trading Rand to understand what inflation is doing, because whether you look at inflation or you look at the Rand, both are different sides of the very same coin. If Rand is weakening or if inflation is rising quite sharply, you are talking about the destruction of purchasing power of every Rand you have in your pocket. So if you've got a better perspective on inflation, for example, and the monetary dynamics that are working towards keeping inflation under control, you also have some sense that, well, there isn't a fundamentally strong reason for the Rand to weaken substantially further. Of course, we've got to take that in the context of the earlier part of this presentation, which had to do with the US. But in terms of local factors, Rand for the time being should remain resilient, and I say that knowing full well what's happened over the past couple of days because of these riots. A big factor has also been the way that the trade account has just gone from surplus to bigger surplus to even bigger surplus. It correlates very strongly with private sector credit extension. Again, what I've done here is I've inverted private sector credit extension. It's the same chart as you had before, but all I've done is invert it. So if you look at the left-hand axis, as you go up the axis, the numbers decrease. And I did that just so that I could correlate it with the trade balance so that you can see what actually drives the trade balance. Domestic demand, which is reflected by private sector credit extension, is a big factor in driving what we've currently got as a trade surplus. So the weaker the credit cycle, the stronger the surplus. And why? Well, it's very simple. We import a lot less, and that against the backdrop of South Africa's terms of trade, which are the strongest in 10 years, and our exports that have continued to do well. As things stand right now, and thanks to the weakening that we've had over the past couple of weeks, the rand is now 15% undervalued. One could argue that it deserves to be here because it's got a price in a fair amount of risk related to South Africa, and one could also argue that that risk just ramped up through the course of this week. So perhaps that 15% undervalued goes back to 20% undervalued in the short term. Again, we think that if our take on this is right and that this does eventually blow over, that the rand is going to make a bit of a recovery from these weaker levels. I'm not saying it can't go weaker in the short term, but I'm saying that there is opportunity for it to come back from these weaker levels. The rand sentiment indicator has, however, turned. It's telling us that sentiment going into 2022 is going to be particularly weak. And so rand towards the back end of this year, beginning of next year, is likely to come under a little bit of pressure. And that's notwithstanding the fact that South Africa ranks pretty high up on the carry attractiveness score. So South Africa is fourth from the top out of 22 countries on carry attractiveness. That helps, but unfortunately, it's not the full story. For the full story, you've got to take South Africa's fiscal position into consideration, and the fiscal position has been poor. So South Africa ranks just second last out of 22 countries, and that's very much a function, going back to the early slides, of what may have resulted in South Africa's Arab Spring, is the very poor performance of this government, how it has run its finances, the bang for buck that it has gotten out of the way that it's deployed its finances, and where that ultimately leaves us now. If you look at the debt to GDP ratios of South Africa, we definitely cruising up towards the 85 to 90% mark in the coming couple of years. And that is going to be uncomfortably high for a country that runs interest rates as high as 10% or a little bit more. So the next chart just literally gives us the breakdown of those resilience indicators in time series format to show you how there's been erosion across the board, but that fiscal risk, the red line, is the one that scores the poorest. Out of 10, if you look at the y-axis on the left-hand side, South Africa is scoring just 1 out of 10, which is a terrible, terrible score. It's unfortunately hampers us massively as a country. It means that there are some very deep reforms that are required if South Africa is going to get out of this fiscal mess. Save for those reforms coming through, it leaves the South African rand vulnerable to longer-term weakness. That's just South Africa's ranking overall on the resilience score. We rank third from the bottom overall, and it's only thanks to fundamentals and monetary prudence that we even third last and not stone last. So quite clearly, when you take all of that, and it's becoming a favorite chart to show, but when you adjust the South African rand for the fiscal risk that currently exists, and you don't believe that it's going to be materially tackled, then you find yourself deep in overvalued territory, even at these sort of weaker rand levels. So Wichard, that brings me to the end of this presentation. I know there's a lot to take on board there. We've gone from structural problems that potentially led to these riots that we've got right now into US inflation and interest rate dynamics, and back across to rand. So there's a whole lot there, but I think the bottom line remains the same as it was before. Once you look through a lot of this noise, you can understand where the frustrations are coming from. It's probably been a long time coming. It's now impacted and hit. We are going to have to take a long, hard look at ourselves as a country. The one good thing that tends to happen after a crisis of this nature is that policymakers tend to look at things a little in sharper detail to see where they've gone wrong. And potentially this is a trigger for some reforms to come, but there's no guarantees. Where that leaves Rand at the moment is in a little bit of limbo. We are unclear as to the exact outcome of inflation over the next 12 to 18 months in the US. We do believe that's going to be temporary, in which case the Fed doesn't have to hike aggressively, in which case Rand doesn't need to blow off that aggressively. But at the same time, we do have domestic factors that are weighing, and at least for the time being, that is affecting the performance of Rand. Wichard, I'm going to hand over back to you.
Thanks so much for the George. Yes, I've just got a quick one. Obviously, there's a lot of talk about obviously inflation, but about when the Fed is going to stop with the QE program printing money in the US. And effectively, what we've seen in the reverse repo market is that the Fed is taking a lot of money overnight every day, almost up to $1 trillion. It's the high print was about $930 billion. Is that not effectively the start of tapering in the US?
Yeah, I think it is. They did this trick the last time with quantitative easing, in that they started to withdraw liquidity out of the system. Not obviously, not in terms of doing it at a Fed funds level, Fed funds rate level. So they didn't do it there, but they did offer banks very attractive interest rates to deposit their excess funds back with the central bank. And in so doing, they pulled a lot of money back out the system. We think that is happening again. In fact, we know it's happening again. So that is the start of tapering, if you like. But it's not tapering in the sense that they are pulling back on QE. Right now, they're still printing 120 billion per month. They're not likely to stop that anytime soon. All they're doing is offering the banks the ability to park excess funds that they're not utilizing back with the central bank in a bid to help them strengthen their balance sheets and make themselves more ready. But if you're asking me if that's an interim step towards tapering, I would say absolutely it is. After that, you would see them gradually start to reduce the amount that they purchase every month, and then after that they'll manage that process out. They've learned a few lessons from the first time round. I don't know that we're going to have a taper tantrum this time. They'll be very careful in how they phrase things and how they position themselves and how they manage liquidity in the markets, and that, I guess, at the end of the day is going to be what makes this presumably a more successful reduction in stimulus than was the case the first time.
100%, thank you. I just got another question quickly. The US has got a moratorium on kicking people out of houses up until August. If that moratorium is lifted, will we probably see the rental market reprice, because a lot of people can't pass on rent and all of that stuff? Will we see the housing market reprice for higher rent? And how much of an impact will that have on inflation, and maybe making inflation not as transitory as the Fed is expecting?
So that's the big risk. And I mean, you've touched on one of the factors that's been doing the rounds, and guys are a little bit concerned about things like that. The counter to that argument is that the economy isn't in full-blown having recovered fully yet. That they're going to be ending their stimulus checks now in any event pretty soon. We'll start getting, the dust will settle on the labor market, in that we'll get a better sense of exactly how strong or weak it is. And I think, it's not just about the rentals. The rentals are just one aspect of it. What will happen to wages, for example, because we know that there's a huge demand. The job openings at the moment, if you look at the JOLTS data, is sky high. So a huge amount of job openings. Part of the reason why those job openings are so high is because people are enjoying sitting at home and receiving their stimulus checks. They don't have to work. So they're going to need to end those stimulus checks first. Then you'll see people going back into the market. The stimulus checks on their own are not strong enough to prompt landlords to jack up rental rates. Not yet. The first thing they're going to do is try and recover what they haven't been paid. And then only after that, when they are a lot more confident, I think, do you see those rental prices go up. So there's an interesting dynamic there. I can't tell you with 100% conviction how it unfolds, but I do think that it is a factor. But there are others that are equally important, if not more important, and those would be, for example, wages and how wages unfold over the next 6 months or so, because this labor market at the moment is very disjointed. It's not operating normally in the sense that people haven't gone back to work yet.
Okay, 100%. Andrew, I've got a question for you. Wilfred has asked here that the rand seems less susceptible to domestic events of late, mentioning Nenegate that happened a few years ago as an event that had enormous impact on the rand. He asked, what is the reasons for local events being less relevant?
Yeah, I mean, it's very much a function of we're running a huge trade surplus, massive trade surplus, record trade surpluses, and we're running a very, very tight monetary cycle, the combination of which protects rand. It will do every single time. So at this stage, you combine those with terms of trade that are the highest they've been in 10, 11 years. The combination of that is just giving the rand a little bit of resilience. I mean, at face value, that's what it is, at a superficial level. I concern myself when like further out. So, you know, one mustn't be fooled into thinking that what you're seeing right now is sustainable long term. It might be sustained until end of the year, beginning of next, and the like, but it's not necessarily sustainable long term, because we've got a fiscal problem. We've got a really big fiscal problem in this country, and it's not getting resolved. And in fact, what we're seeing at the moment, when you asked that, you made that point right in the beginning, Wichard, you were saying, you know, what sort of impact is this going to have on the fiscus? It's huge. It's absolutely huge. You've just gutted a whole bunch of malls. You've had a big impact on the retail industry. You've lost out on VAT. You've potentially resulted in a whole bunch of businesses closed. A whole bunch more people are not going to be receiving salaries. So PAYE gets a knock. And just at a time when things were starting to look a little bit better for South Africa on the fiscal front, just as it looked like we were onto, you know, slightly better things, all of a sudden you now hit with these riots and the looting and the damage and the destruction that's come through. And that's going to take years to recover if we even do. There's some businesses that will close, that's for sure. The big retail players, they've got the ability to rebuild. But, you know, that takes time. And in between now and when they're back to full capacity in those stores and those malls, you could be talking about a year, maybe plus. I mean, who knows how long it takes to rebuild and reopen a mall.
Andre, your views on it?
Well, in answer, yes. The economy, when all of this happened, was in a better shape. Trade figures pointed that out. We were in a growth phase, coming out of the heavy lockdowns of the pandemic, etc. And that's that's some of the reasons why the rand, in reaction to this turmoil going on around us at the moment, is a little bit more resilient than it was during a Nenegate, etc. But going forward, I would agree with George 100%. We are still sitting and being faced with huge problems that is currently not being addressed. Here we've just had Mr. Mboweni telling us that there will be no increases for state employees to curb the expense on the salary side. But if you really go and look at it and you analyze what's being put on the table now, you're speaking in excess of inflation, well in excess of inflation, as to what the increases will be. So these problems on the fiscal side is not being addressed, and now comes the cost, not only the cost of rebuilding, but the cost of actually curbing and stopping this violence and getting it back to normal is also enormous amounts of money that's being spent. Once again, not productive money being spent. At least we'll get some positive out of it, and Sasria will be paying out huge claims, and that will assist in rebuilding. But, you know, ultimately, we are just making matters worse by stealing and looting all the time, because we're making the poverty situation worse. Problem is, what we also need, and that is being asked by government 150%, 175% of the times, that this is something that needs to build South Africa into a proper future, is something that needs to be done in conjunction with the private sector. And the private sector seems to be sitting back on their backsides and waiting for government to do something first. This is not a chicken and egg situation and who moves first. This is a partnership that needs to be brought into place. And quite honestly, I don't think that the private sector is also always so innocent in what they do. You know, when I read on the news wires of people getting bonuses of 100 million rand in excess of that, joining fees, they get 1 million shares to join the company as a new CEO, etc., etc. You know, that is not. Everybody on the news wires, on social media, reads about these things. They read about these fantastic big bonuses being paid to people in the private sector for not even really making money. And I can tell you quite honestly that when I go to the shops, I don't get better service from most of the stores that I go to than I get from the government. Simply because the queues are long, and then they tell me that it's COVID. Everybody blames it on COVID. There's no more. There's not enough staff. There's not enough this. That's not a private sector coming in conjunction with government to try and solve a situation. That's just sitting back waiting for somebody else to do things before you do it. But in short, we are more resilient at this point in time because we were in better shape. But the way things are going now, we're pulling ourselves down, and do not be surprised if we see further blowouts if this continues too long.
Got two more questions. One is from Peter. He wants to know what is the dollar and house view for 2021 and 2022. And a question from Andries is, can the South African economy recover from the current looting? And if so, how long would it probably take?
Okay, who wants to take that one? George, you, me?
You can have a stab at. You can. I know you like to give the views on the house views on Rand.
Well, at this point in time, to give a clear view and say that it's going to go in this or that direction, I think is a bit foolish, because it's so vulnerable at this point in time that anything can happen. What the question, I think, should really be, you know, how do you manage yourself through something like this, and how do you steer yourself through something like this? Now, you know, when we were below 14 and in levels and we were extremely strong, we advised people to take some forward cover on the imports. We said wait for levels above 14 before you start looking at taking advantage of the exports. What is it that we say now? I think, be it either importer or exporter, you have to look at your very, very short-term commitments and then decide what products is available so that you can steer through this in this absolutely turbulent time where we could go down to 14.30 and back to 14.20 very quickly, and we could very easily also see 50 on the cards very quickly. As for 2022, I do not think that this will continue unabatedly, and I think we will recover, and I think we will see better levels. And I would still think that during the course of 2022, taking inflation and inflation rate differentials into account, that we'll most probably speak about a level of around 14.80 to 15.20 for the 2022 year. And for this year, I would still very much think that we're on track to end the year around somewhere between the 14.40 and 14.70 levels. What would you say?
Yeah, I would. In fact, I think, and I like the way that you're thinking about managing through this process, because I think that's wise. You know, there's no perfectly right and perfectly wrong answer, but there are better and worse times to do certain things. And like right now, Rand has come back a long, long way. I mean, if you consider that at the beginning of June, we were sitting at levels of around 13.60 to the dollar, and we're now sitting at 14.60 to the dollar. You've dropped the buck in just over a month. In 6 weeks, you've dropped the buck. So things are a lot. And back then, we were talking about the possibility of even touching 13. So, at 14.60, I think there's some value here for exporters. Could we touch 15? Absolutely. With what's going on at the moment, definitely possible. But if these levels for an exporter are looking attractive, I would certainly be selling into some of this, selling dollars into some of this rand weakness. I would be doing that for the time being, because I'm not convinced that this is the time that rand just automatically goes weaker and weaker and weaker. That time will come, but I don't think that's necessarily a 21 story. So I could easily see rand, maybe it goes a little bit weaker to the 15 bucks, but I could easily see it coming back into the low 14s or even back into the 13s before the end of the year. Stabilize then and then weak and start its grind weaker. What's happened this time around is a little bit different, and it depends how this all unfolds. If this blows over reasonably quickly, and we get back to some sense of stability and we get back to dealing with COVID and vaccinations and starting to rebuild the economy and getting back to a more stable trajectory, rand can come back. Within a month or two, we can be talking about much stronger levels and people scratching their heads saying, why is it so strong? I don't think that's going to be long lasting though. And that's the point. So if we get up to between these levels and 15, there's value there for exporters. Equally, once we're through this and we start moving in the opposite direction, I think importers need to be wise to look at their own books and see where they believe that value can be found and to mop it up, because I don't know that levels substantially below 14 are sustainable long term. I think anything below 14 offers value to importers, anything towards 15 to exporters. It's a very wide range for you, but that's where we've come. Like I said, in 6 weeks we've moved the rand. So this is what happens. And going into 2022, then I would tend to shade it more towards rand weakness than rand resilience and strength, and maybe I think the average that Andre was alluding to was something closer to 15. I can live with that, but maybe towards the back end of next year, I'd be talking about a weaker number than that.
100%. Quickly, we've got 1 minute left. Just Andres' question about the current looting and how long it will take to recover from this, more or less.
It's such a difficult question to answer because, I haven't seen anything quantified in terms of how big the impact has been. It doesn't. You don't rebuild them all overnight. Just like you can't restock a shop just like this. Maybe your big retailers can get up and running a lot more quickly than the smaller ones, but there's a lot of damage that's been done. And a tremendous amount. Yes, insurance can help to some degree, but it will never cover everything. And there's still an interim period. You got to get paid out. You've got to go and do the purchases. You've got to restock. You've got to redo your shops. That's going to take a long, long time. So I don't know what percentage of the retail economy has been hit at this point. We'll see it come in the numbers over the next couple of months, and then we can give you a clearer perspective on what that might look like. But I would say, this is not going to be something that you recover from in a month or two. This is going to take a lot longer than that, probably closer to a year.
I think that the rebuilding will take a considerable amount of time. I think the absolute turmoil and the looting and etc. that goes on, so the absolute chaotic situation could most probably be with us for another week and a half before 100%. We actually really bog it down and get some peace and stability back.
100%. Thank you everybody for your time and attendance. Thanks to George for the presentation. Thanks for all the questions we had. I hope everybody found it insightful, and have a wonderful afternoon. It's very cold out there, people, so stay warm, stay cold, stay safe, and be safe from COVID as well. Bye-bye.
Thanks, everybody. Have a good one. Bye.